This is Tim Phillips, Chief Investment Officer at Phillips & Company Advisors. I'd like to welcome you to our Q3 China Look Ahead. Please read all the disclosures carefully. Based upon current vaccination rates of over 20 million doses a day, China should achieve herd immunity by August or early September. Their ability to contact trace, isolate, and vaccinate large segments of their population should limit regional outbreaks like they experienced in early June. There's a race to recover in manufacturing, services, and retail in China. A full recovery in manufacturing is well established with some drag in the services sector or non-manufacturing. You can see that in this chart. However, a regional virus outbreak in the major port city of Guangdong created a backlog of traffic in early June. Now, that blip in export traffic and manufacturing will likely recover in the coming quarter. On the retail sales front, retail sales will continue to expand in Q3 with a bump in services over goods. Weaning off government support will be easier for China versus the US in our opinion. As a percentage of GDP, China needed less fiscal support than the United States to prop up their consumers and businesses. They simply had better social control earlier than we did. China's use of deficit spending may result in a less volatile return to normal for them over the United States. China tweaked their budget deficits from around 3% range, which is normal, up to about 3.5% in 2020. And it's expected to be back down closer to the 3% range in 2021. On the other hand, the United States supercharged their budget deficits to nearly 18% of GDP in 2020, 10% in 2021, and won't likely normalize back till 2023 or 2024. While the RMB has been on steady decline the last 6 months, a recovery in China's domestic currency compared to the US dollar occurred this last month. This might suggest further China A-share buying. When China's domestic currency strengthens compared to the dollar, there is a high correlation to foreign buying of China equities. Now, we expect the RMB to continue to strengthen in the coming quarter, driven by prudent but supportive fiscal and monetary policy, inflation moderation, and a stronger recovery in small and medium businesses tied to the service sector. China A-share activity demonstrates some serious macro tailwinds. Stock Connect traffic continues to grow, and the chart below reflects that consistent growth of inflows. Now, the Stock Connect program allows for foreign buyers like us to access the China domestic markets or northbound flows. Further, it allows domestic China investors to access the Hong Kong markets or southbound flows. Those net buyings continue to increase, and the expectations for them to continue to grow in the coming years. Foreign ownership of China domestic stocks should far exceed some of the much smaller Asian countries. As you can see in this chart, China onshore ownership is still very small relative to foreign ownership of other markets. We believe this will provide significant market tailwinds in the years to come. And further, major index inclusion is still on pace to provide macro buying to domestic China equity markets. Some think this will soon normalize, perhaps in the next 5 to 7 years. Thank you for your time and attention, and please contact your advisor or myself with any comments or questions.